Perhaps this is a whole new development for Luxembourg in this decade, which is going beyond the established position it has here in Europe as the EU's dominant fund centre, and looking to create a whole new role for itself as the place, dare I say it, outside North America, which will become the global capital of the fund industry, certainly on the support side of that business, where the same model that applies in Europe, where you can indeed have a fund that is distributed by Italian distributors to a local market in Italy or in Spain or in Sweden or wherever it may be, but all the distribution support and the servicing takes place in Luxembourg. Well, exactly the same thing can happen in Taiwan, in Thailand, in Singapore, in Chile, or wherever it may be. And the point of this discussion this morning is to see whether that is going to be what's going to happen over the next few years, or whether or not we're going to see something else happening, which is that as the fund industries in Southeast Asia, in Latin America, indeed the Gulf and other parts of the world develop, will they also develop their own local distribution support and administration services in the locality where they are based? And therefore Luxembourg will continue on as it is, no doubt, in Europe, doing the job it's doing for EU-based funds, but this won't be necessarily the great, huge new development coming up over the course of the next few years. And that's principally what we're going to be discussing here. So we are delighted you could join us. I'm now going to introduce the panel, and I'm going to ask them all to speak for a few minutes to kick this particular discussion off. On my furthest right is Charles Müller, who's the Deputy Director General of ALFI. ALFI is the local fund industry association. And ALFI, Charles, I believe, opened an office recently in Asia and Hong Kong. So it's now part of this particular process that I was referring to a few minutes ago, in that it is opening offices in parts of the world outside the European Union. On my immediate right is David Mikhailov. He's Managing Director and General Manager of the Bank of New York Mellon in Luxembourg. And David, thank you very much for sponsoring this particular webcast this morning. It's extremely welcome. And on my immediate left is Denise Voss. She's Conducting Officer of Franklin Templeton Investments here in Luxembourg. Franklin Templeton, as everyone I'm sure knows, a very large fund manager with particularly strong connections in Asia. And in a few minutes when we come to her, she's going to explain to us all what a conducting officer is. And on my furthest left is Mark Evans. He's partner at PricewaterhouseCoopers here in Luxembourg as well. Thank you all, panel, very much for coming along this morning. Can I come to, I think we said we were going to go to Mark first. Mark, can I come to you for to kick this discussion off as to where does PwC see the role of Luxembourg in the coming years in relation to what I was talking about?
Sure, Simon, and good morning, everyone. And I think in relation to Luxembourg's role within the global investment management industry or global fund industry, I think it's a combination of thinking what or where Luxembourg will be in the future in the next 5 years, 10 years, but also to just take a stock for a moment where Luxembourg is today. I mean, I think you can make a very solid case for the fact that today Luxembourg UCITS products, typically Luxembourg SICAV products, are known around the world today as the only globally distributed product. And I think it has a unique position today, not only in Europe, but in many of the other markets that you have mentioned. Now, that's not to say that in the future there will not be pressures put upon Luxembourg and the extent of Luxembourg fund, let's say, dominance in many particular markets. And I will come back to that. But I think today we just need to reflect on the fact of where Luxembourg funds are sold. I mean, they are sold in more than 60 jurisdictions around the world, and I think that is testament to to the success of Luxembourg, not just in the last 2 or 3 years, but really over the last 10 to 15 years. You know, groups like Denise's, other large financial services organisations who've created extremely large Luxembourg platforms. They're sold in 15, 20, 25 countries. I mean, today there's about 220 fund groups selling on a cross-border basis. About 70% of those groups are using Luxembourg funds, and about 30 or 40 of those groups are really sold, or those platforms are sold on a global basis in 40, 50, 60 countries. So countries like you've mentioned, Asia, regions like Asia, countries like Taiwan, Hong Kong and Singapore, not only are Luxembourg funds well represented, they basically dominate those local markets. I mean, if you look at Hong Kong, you know, if you look at the whole Hong Kong fund industry, 85% of funds are foreign funds. The local industry is only 15%. If you look at that 80%, Luxembourg has about a 75-80% share now. Same in Taiwan. In Korea, 100% of all foreign funds sold into Korea are Luxembourg product. So I think Luxembourg's position today is one of a tremendous spread around the world, supported by both the operations here in Luxembourg, but also many of the providers, and David will mention this, have set up sort of global hubs in Asia, in Latin America to support that global distribution. So I think where we are today, Luxembourg funds are dominating global fund distribution. The issue is what will happen in the future. And I think the future is relatively rosy. However, I would say that there are a number of issues on the horizon that Luxembourg needs to be aware of, needs to take note of, and maybe we can come back and talk about those a little bit later.
Thank you very much. Yes, absolutely. Precisely what we will be doing. David, can I come to you from your perspective, from the Bank of New York Mellon's perspective on this issue? And I know you've been out in the Gulf, amongst other places, servicing funds that are distributed there.
Indeed. Just to reinforce the point, I mean, it's absolutely valid that this is not new to Luxembourg necessarily. Global distribution, given the cross-border nature of our fund base, is something we've been dealing with for 20-odd years. That's not to say that we obviously will rest on our laurels. We're very conscious that, particularly with things like UCITS 4, that's going to open up the market in terms of where intellectual capital can be stored. However, there is obviously a shift, and has been a shift, particularly in the last couple of years, towards Luxembourg becoming a centre of excellence for global distribution in particular, as well as the more what I call value-added services. To come back onto sort of the models, you touched on models, Mark, absolutely. Most of us, and a lot of my peers in the same space as me, we do operate global operating models, particularly in transfer agency, where we have regional hubs. So in our own instance, for example, we have a Singapore hub, which services the Asian clients. So in time zone, they speak Mandarin, Cantonese, the communications which go out, the fulfillment goes out in foreign languages, including Chinese, for example, and effectively act as a conduit into the register, which is held in Luxembourg. And on the other end, also to your point, we use Syracuse in the US, which services the Americas, and channels such as NSEC. I think another thing that is to be noted is that because we've had such a long history of building this architecture, we're very embedded with most of the major distributors. If I take some of my major flagship groups, for example, they may be linked to 400 distributors, so all of the big names, as well as the platforms, so the supermarkets, the Vestimas, the fund settles, and so forth. And that is proving very beneficial because we're achieving straight-through processing rates probably in the 60% range. Doesn't sound impressive compared to custody, but we have to remember that transfer agency is only really in the last few years got to grips with that stuff, and until there's standardized ssaging around TA, you'll never get to 100%, but people are working on that separately. So I guess that one of the advantages of Luxembourg is this deep institutional memory, the language skills, and the fact that, as you rightly say, most of the large umbrellas we're dealing with, and Denise will bear this out, are distributed cross-border through a significant distribution network into 30, 40 countries. And as service providers, we've had to learn how to deal with that and how to manage the setup and the registration and the linkage in each of those countries. If I can just pause briefly and just also say that I've said we weren't going to rest on our laurels, and that's absolutely the case. We're aware, particularly UCITS 4, that people can choose to domicile, we call it the intellectual skills, elsewhere, so the UK if they wanted to, for example. But there's a recognition, certainly in my organisation, that you'd want to leverage the institutional memory and all of the skills that have been built up over those years to push it forward now into the more value-added space. So our challenge going forward is actually to give clients the value-added, to actually make sure that we're helping them build their book, because it's mutually supportive. The more that they are able to distribute and gather assets, the more that we as service providers obviously make on the back of that. So we are very aware of that, and we're trying to develop areas of expertise where we actually will support clients in their distribution efforts. And examples will be that some of my product experts will actually go with clients to regions like Asia, and they'll follow them around. Literally, we'll hold their hand as they visit the Taiwans of the world or the Chinas, and discuss the operational and distribution requirements as they meet the regulators or the lawyers or the distributors and so forth. So we effectively build almost joint action plans to help these clients actually penetrate and distribute. So,
thank you very much. And Charles, can I come to you for your opening comments? As I said in my introduction, Alfie took the interesting step last year, I believe it was, in the middle of last year, to open an office in Hong Kong. What's your view on all of this, and why in particular did you decide to open an office in Asia?
Perhaps I would like to start by saying happy birthday, not to one person specifically, but to all of us, because the UCITS directive has just turned 25 in December, and the UCITS directive is really the basis of the success of the Luxembourg fund industry. We had a first mover advantage then, we have a first mover advantage again with UCITS 4, we're the first country to implement UCITS 4, so if the success of Luxembourg is today quite prominent, it's hard work as well, and certainly the Hong Kong office is another part of this hard work. I agree that the success of Luxembourg is based also very much on language skills. You must know that out of the 500,000 Luxembourgers, there are 200,000 foreigners living in the country, and another 160,000 crossing the border every day to come and work in Luxembourg. So the multinational environment makes that the language skills are present, and since we never had a home market, we from the early days on concentrated on exporting market. Obviously in the EU in the first phase, and then, as you rightly said, now more and more outside of the European Union. Another point that I would like to make is that while UCITS is still the main part of our business, more and more we are seeing that alternative funds are also present in Luxembourg. We have now over 1,000 SIFs, so specialized investment funds in Luxembourg. That's roughly a third of all the funds that are here. And with the AIFMD, the new directive that is coming up for alternative funds, what we believe could happen is that we could replicate the success as Europe of creating a brand also for the alternatives, and also to have this type of vehicles then being sold more and more outside of the European Union. Going to these markets in Asia, in the Middle East, in Latin America is hard work, and we as an association, together with the government, and I think that's another specificity, the fact that we work together with our government, that we are very active in promoting Luxembourg, opening new markets, going to see the authorities in order to get the UCITS product, the Luxembourg UCITS product accepted for distribution is a major part of our efforts, and having people on the spot, like for the Hong Kong office, is also a trend that we would like to go, is to, instead of being on planes all the time, is to really be in this market, talk to the regulators, talk to the distributors, talk to the clients, in order to be as near as we can to to the people who buy our funds. Important perhaps to say is that distributing all these markets requires an important know-how. I mean, in Europe it's quite easy, you have a harmonized framework, but once you go outside of Europe, if you want to register your fund in Taiwan, you have to comply with Taiwan regulation, tax regulation, filing requirements. If you go to Hong Kong, the regulation is different, and so from each market, from market to market, you have to comply with local regulations. So the real know-how is to be able to have the same fund as, for example, Franklin Templeton is doing, having the same fund that you can then distribute while respecting all the regulations from all these different markets, and not having to replicate the funds, having one fund per market, which makes things much more expensive. So it's hard work, and it's a lot of know-how that needs to be put in place in order to be able to do what we do in Luxembourg today.
Thank you very much. And Denise, may I now turn to you, and amongst other things you're going to tell us what a conducting officer is. And as I said in my introduction, Franklin Templeton's extremely well-known name fund manager, particularly in Asia. You see when you're walking around Hong Kong and other parts of the region, lots of billboard advertisements for Franklin Templeton. You're very much embedded in that part of the world.
Thank you, Simon, and good day to all the listeners and viewers. Conducting officer, what is that? Well, effectively, when UCITS 3 was implemented into Luxembourg law, the Management Company Passport Directive, the Luxembourg regulators decided that for the part that related to substance, they would put into place a conducting officer, 2, as a matter of fact, for every UCITS. And a conducting officer is effectively an agent of the board of directors of the fund that is responsible for the day-to-day oversight of the fund. So my job is to review and oversee all aspects of the fund, and I report to the board at the board meetings and obviously on an ad hoc basis as required. So we are the eyes and the ears, arms and legs, what have you, of the board of directors of the fund, which is obviously a product focus and often quite different compared to the way companies are normally organized on a functional basis. So we try to bring it all together. And obviously we are vetted and approved by the regulator, the CSSF in Luxembourg, so it's seen as an important role in the ensuring that funds are taken care of properly. Franklin Templeton's been present in Luxembourg since 1991. Effectively, we were in Germany selling a U.S. registered fund in the early 80s, which was the reason for us continuing our business and for us being aware of the opportunities of UCITS when it was put into place in the late 80s, early 90s. Obviously, Franklin Templeton management, hats off to them, because they clearly saw that it's a U.S. company, and they clearly saw that they weren't going to be able to continue to grow forever in the U.S. They needed to go outside their home country market, and they saw UCITS as the opportunity to do that. Luxembourg, I think, was an obvious place for many of the reasons that had been elucidated before. The multi-currency, the center of Europe, etc., and the willingness of the Luxembourg government to welcome fund groups and to help them implement their projects. The fund itself, as I said, has been in existence since 1991. It's, over the last 20 years, grown to over $120 billion. 68 portfolios, so fixed income and equity investments in companies and countries around the world, 40 classes, 700 asset values on a daily basis, so it's a bit of a beast. And initially, when we launched the fund, of course we were looking to take advantage of the UCITS passport, so registering the fund in Europe and establishing relationships with distributors in Europe. But already in the last half of the 1990s, the fund was registered in Hong Kong and Taiwan and in parts of Latin America. So we've really been at it for a long time. And I think one of the reasons why you see the advertisements in Asia, etc., is obviously the opportunities given to us by UCITS, but it's also, UCITS has allowed us to make a commitment in putting ourselves out on the ground around the world. And it's been the vehicle that's allowed us to do that. I mean, I think in many ways, UCITS can also be the door opener, because UCITS is very well understood. The Asian regulators have traditionally felt very comfortable with UCITS because of its investor protection rules. I think investors have been very interested in it because it obviously gives them a huge choice of investment strategies within one legal umbrella entity. So it's easy in that respect, as long as the personal tax issues are not there. So often, I think we've also seen UCITS, again, as I said, as a foot in the door to these markets, creating local products where it makes sense, where tax, for instance, doesn't make sense for UCITS. But at least it helps get the name out there. In terms of recent trends, certainly we've seen, as has the rest of the industry, quite a lot of flows from Asia and the Americas versus some of the traditional European flows, but those are continuing as well. In terms of product, there's quite a bit of focus on retirement and how the investment management industry can answer the need for retirement products, so discussions about multi-asset allocation, liability management solutions. I think Luxembourg's been very good at product development over the last 25 years, and I don't see why it wouldn't continue to be good at that, given the experience of the regulator, the service providers, and the others supporting the fund industry. I think also a big advantage, and why I believe that there's I think Luxembourg, actually I agree, is already a global fund center, and I think it has a good chance of continuing to do that. One reason is because of the global mindset and I like to say, the passion for doing business globally. I think that it really is embedded in all of us in Luxembourg, and I think it makes a big difference. And what else can I say? I think that's about it for at this point, so we could continue. Or
thank you very much. That's exactly what I was hoping for from introductory comments. And by the way, those of you out there, I forgot to say this at the beginning, you are extremely welcome, and indeed we encourage you to email in questions live during this webcast. So you can do that anonymously, you don't have to reveal who you are. We have indeed already received one question, and I think I might go straight to that question. Somebody has emailed in to ask, let's just see what it is. Can you tell me if there is a difference in perception between Luxembourg and Irish-based funds in Asia? I presume by that question they mean Irish-based UCITS funds and Luxembourg-based UCITS funds. Is there any difference? And perhaps I can ask you all to answer that, but also I'd like to expand on that question and ask whether or not, I don't want to necessarily get into a sort of Ireland versus Luxembourg debate too much here this morning, but nonetheless, what's happening here in Luxembourg in relation to what you've all described taking place, particularly in Asia, but in Latin America, as you referred to as well, is the same thing happening from Ireland, from Irish-based funds?
Yeah, if I can start off, Simon, I think Ireland is quite similar to Luxembourg. They were a relatively early adopter of the UCITS directive. They've built an industry, an export-based fund industry to sell and promote Irish funds all around the world, and they've been quite successful in that as well as Luxembourg. So I think there are many similarities with Luxembourg. So in answer to that specific question, there's probably not a significant perception of any difference between the Luxembourg product and the Irish product. They're both UCITS products. They both have similar in those products, similar features which allow for flexibility. I think there's general acceptance of both products around Asia. And if you look at the market shares that Luxembourg product has within Europe, if you look at the market shares that Luxembourg has in Asia and compare those to Ireland, they are quite similar. Although I think Luxembourg's market share in Asia of foreign funds is actually higher than its share in Europe. Because I think many of the promoters with Luxembourg platforms probably entered Asia before some of the promoters with Irish product entered Asia. So I think Luxembourg was a little bit earlier there. But I think, as you know, and we all travel around Asia. It's interesting. We do roadshows. We meet distributors, regulators. The Luxembourg CCAV seems to be within Asia almost the model globally distributed fund, probably more so than what you find in other regions.
Yeah. Does anybody else want to answer that question?
I would like to agree with Mark, and to answer the question directly, no, I don't think there is a difference in perception between an Irish UCITS fund and a Luxembourg UCITS fund, and we very often work together. We are obviously competitors, but also we have the same interests in Europe compared to bigger markets where the local fund industry is just catering for the local market. If you go to France, there are a lot of funds, but they just cater for the French market. They very rarely export their markets across borders. So the cross-border fund industry also has common interests. Also, when there are difficulties in distribution or questions from regulators, for example, I was with Gary Palmer from the Irish Fund Association together at the Hong Kong regulator to discuss certain issues. So it's good to have a competitor. It keeps us on our toes, but it's also good to have somebody to help promote the UCITS brand, and they are very active as well. They also do roadshows, and they are, I would say, in a similar position than we are.
And I think it's true. I think in the early days there was a lot of discussion and time spent about Ireland versus Luxembourg. But I think at this point, I would agree with Charles. There are some synergies where we can gain from.
I was going to say, certainly from a service provider's perspective, talking on behalf of my bank and I'm sure my peer group, we're agnostic. Luxembourg, Ireland, we offer services to our clients in both domiciles, very similar services. I think, to be honest, quite often it just comes down to cultural preference. So, for example, in our experience, you tend to find the Anglo-Saxon and Japanese promoters like Irish funds, probably language, culture. The Europeans and potentially Asians tend to prefer a Luxembourg product. And that's probably because of the frameworks we talked about in terms of legislation and the look and feel of the brand, the UCITS brand, and even now the CIF brand, which is starting to have a Luxembourg identity. I know Ireland's got the QIF, but CIF has been incredibly successful. So there isn't a huge fundamental difference now. I think it's really, I call it herding instinct sometimes in certain regions. People have an exposure to certain products and they work for them, so they tend to
and they become
propagate.
Familiar with those products.
Indeed.
No, and what Charles said a little bit too. In fact, the challenge going forward with the UCITS 4 is more the France, Germany, the domestic markets, the domestic fund groups looking to perhaps bring their business back into their own countries. That's perhaps more of the challenge than the Luxembourg versus Ireland.
Yeah, and I think that's going to happen.
Given what the management company passport and what that allows.
I agree. And not just in Europe, Denise, I think all around the world. And in my opening comment, I sort of touched on the success of Luxembourg in the last 15 years, especially the last 5 or 6 or 10 years in Asia. But I think on the horizon there are some warning signs that we need to be aware of. And I think Luxembourg and probably Ireland as well need to think about how they will respond to that. And I think it's not just in Europe that there are some local fund associations together with those large domestic markets who are looking to say, well, maybe we need to be creating more exportable product. Now the question is whether they will be successful, and I have my doubts about that. And I think that's happening not only in Europe but in Asia. There's a lot of discussions, some early moving on an Asian fund passport, because they are looking to say, well, look, are we going to let the UCITS continue to dominate Asian fund distribution? So I think there are some issues that we need to be aware of.
But a lot of it comes down to what David was talking about as well: the know-how, the experience, the service, the global mindset. And going with your clients to these places to help them discover how they can actually put their these ideas into place is a huge advantage. And the expertise and the know-how, and it doesn't actually come overnight, that kind of expertise.
Well, yes, and a subject which I wanted to pick up on that you raised, I think, in your introductory comments a bit earlier on, which is you talked about UCITS 4 in relation to where the intellectual capital of the fund is held, and you, I think if I understood you correctly, made reference to the fact that it makes it easier under UCITS 4 for that to be held somewhere else, London or New York, wherever it may be.
That's right.
Can you perhaps explain that concept a little bit more, exactly what you meant by that, and why, if it is the case, that might help not only with distribution of funds in Asia or Latin America, indeed here in Europe? How does UCITS 4 help globally? That the whole case for Luxembourg or indeed Ireland, whatever.
Yeah, indeed. I'll try and break it down very simplistically. So we're thinking about things, we're thinking about global distribution, we're thinking about how do we get close to our clients, help them to understand the possibilities for distribution, and to build their book of business. And it is educational, and to be honest, we have some clients who literally, for example, come out of the US, they've never distributed in Asia, they've never distributed even in Europe. And so it's a hand-holding exercise. Now, a lot of those clients, obviously, particularly for the Luxembourg book of business, for all the service providers, I would say, are not resident in Luxembourg. They come from the UK, they come from the US, they come from Germany, Switzerland, and so forth, and Asia. And so what, particularly under the UCITS 4 framework, it may well be more appropriate to centre your, call it your point person, your point of reference, in our instance, for example, in the UK. I've got lots of UK clients, the Barclays of the world, for example. So they've got a go-to person in their location, effectively, that is the conduit into some of this institutional memory and experience we've built up in Luxembourg. So what I'm describing is the concept where you may have this, call it a distribution relationship manager, for want of a better description, based in the UK. He's visiting his clients, he's got regular dialogue, it's face-to-face, and so forth. But the actual intellectual capital that sits behind, which assists with filing the paperwork, making applications, negotiating in certain languages with different regulatory or distributor bodies, building the links and so forth, resides in Luxembourg. So I guess what I'm describing is that the front end can be partnered up in the same country as where your major clients come from, your franchise clients. Your engine room would, certainly in our mindset, sits today best placed in Luxembourg, given the things we've talked about, institutional memory and experience skills and language and the flexible regulatory framework and all of those good things, and just the sheer experience of the cross-border book of business that the 2 trillion worth of largely cross-border funds that we actually administer today.
But what's the difference between UCITS 3 and UCITS 4 in terms of what you've just been talking about? What exactly does UCITS 4 do in relation to that subject matter that you couldn't do under UCITS 3?
Well, I think the main thing is probably the management company passporting.
Yes.
Whereas UCITS 3, effectively you have to build your infrastructure here. With the management company passporting, people are looking to couple this intellectual element with the management company services, which can be obviously domiciled anywhere in Europe. So it's a centralisation of experience, I think.
But effectively, the management company doesn't have to be in the same domicile as the
Correct.
fund. That's what UCITS 4 is all about.
Essentially,
yes.
Which is
and that's
currently
why potentially a French fund, where its fund might be in Luxembourg, it might decide to have a fund in Luxembourg with a management company in France,
right.
Whereas both are in Luxembourg today.
Right.
I think the other interesting element about UCITS 4 is the KID. There will be this simplified key information document, just a 2-pager with very harmonized information about the fund, so that the investor can really compare different products by putting the little sheets next to each other and saying, well, what's the past performance, what's the risk levels, and so on. And that also, again, could be a model for markets outside Europe to take over this information sheet as well. I'm thinking about Switzerland, for example, which isn't in the European Union, but I'm also thinking about other places like Hong Kong. They have, for the moment, their own key fact sheet, but having a more harmonized approach to the information that you give to the investors is also something that the UCITS 4 might bring about.
So just to finish on UCITS 4, but I think the reality is that UCITS 4 is not yes, the KID is quite significant, but when you look at most of the other components of UCITS 4, it's really focused on, it's EU focused to really try and make the UCITS industry more efficient, more cost effective than what it is today. So allowing for fund mergers, allowing for master feeder structure. So it's almost a bit of housekeeping within the EU. I don't know whether it will have a massive impact in terms of global distribution of UCITS product, as UCITS 3 clearly did. UCITS 3 was a real sea change, because what that did, it allowed for UCITS products to have a much broader range of investment possibilities, and those possibilities were very attractive to investors in Asia, in Latin America, in the Middle East. That's not under UCITS 4. So I don't perceive that UCITS 4 will be a significant sea change in terms of global fund distribution.
Right. I'd like to come back to something I touched upon in the introduction, which is, in a sense, the million-dollar question with regards to whether or not indeed Luxembourg and to a certain extent perhaps Dublin become these massive global centres in the same way as Luxembourg has become clearly, obviously, the European centre that it is today. Surely, as Asia becomes, let's focus on Asia just for a second, which is, I think, almost universally considered to be where the growth in the world is going to be over the next few decades, if not for longer, the dominant, fast-growing part of the world. Why, let's step back a second, and I hope and think there are people in Asia following this webcast right now. Why on earth would you want to centralize your distribution support, your administration, your fund servicing, all the stuff that takes place very efficiently and very successfully here in Luxembourg, in this lovely, delightful country in the middle of Western Europe, when all your energy and focus as a fund manager, as a distributor, is in the Asian part of the world? It's, with all due respect to Luxembourg, it's not the easiest place in the world to get to, as I was reminded again yesterday. It would be so much easier if your entire focus is on the Asia-Pacific part of the world, to do all of this from somewhere in the Asia-Pacific region. And people have already been talking about Hong Kong and Singapore. Both of them we all know extremely well, very long connections with the asset management industry. Surely you could replicate all that's done by Franklin Templeton in Luxembourg, and more than easily do it in Hong Kong, Singapore, Taipei, Bangkok, Shanghai, etc. Isn't that inevitably the way it's going to go?
Well, I think it's being done now.
I was going to say.
Well, it's being done now.
I mean, Luxembourg UCITS have only been as successful as they have been to date because of part of the support to that fund and linking to local investors is done in hubs based in Hong Kong and Singapore predominantly. So, in other words, in terms of the fund servicing and the support that David mentioned before for Luxembourg funds, for Europe that's generally done here, all of it's done here. When the Luxembourg product is sold out into Asia, part of that fund servicing and investor servicing is carved out of Luxembourg and put into a regional Asian hub, but with still some support and governance and oversight from Luxembourg. So my view is that it's happening now, that it will continue to happen, and it'll probably spread even further. So in fact, I think, to answer your question, I don't think Luxembourg is necessarily threatened by the fact that, you know, Asian groups who say, well, you know, why do I need to have the fund servicing done in Luxembourg? Well, it's actually not.
Well,
fully.
What would it need to do in Luxembourg then, if this development progresses significantly?
Well, I mean, I think
what's the connection with Luxembourg, or indeed Dublin, or anywhere else in the EU?
Well, first of all, the connection is the product. So the product is based here, and then various parts supporting that product will remain here because of the nature and the infrastructure and the resources here. And then part of that work will be carved out and into sort of centres of excellence based within Asia that will have more of a client-facing role. Because, I mean, you need to differentiate between fund servicing. You need to differentiate between those activities that support the fund and the calculation of the NAV and custody of the assets and all that, and monitoring the activities of the fund, and those activities that are focused on supporting the end investor, providing information to the end investor, interfacing with the local regulators, etc. You can split those two components out. Some of it done in Asia and some of it done here in Luxembourg. And with the sorts of processing that David mentioned before, and electronic links and control environments, that works perfectly well.
If you have a Luxembourg fund, or for that matter an Irish fund, you have automatic distribution possibilities through a passport in the whole of Europe, and you have a wide recognition of your product worldwide. If you have a Malaysian fund or any country out of the EU, if you want to distribute in Europe, you have to go to each regulator individually and try to get your product accepted. And you will not have the same ease in distributing that product in other parts of the world. So the link for the product is obviously Europe. But I agree that already today, part of the work for this product is done in other parts of the world, because it's cheaper, it's in the same time zone, and to be honest, for some time, and it's better now, but for some time we had trouble finding the right people here in Luxembourg. There was more demand than there was offer, and we've just created an expat regime in Luxembourg to to attract new talent and to make it easier to come and work in Luxembourg, because we need more qualified people in Luxembourg. But this does not prevent the fact that for part of the work it's easier, cheaper, handier to do it elsewhere than in Luxembourg.
Okay. Can I give you an example of this issue about the product? So Luxembourg funds are sold into, let's say, Hong Kong. And Luxembourg funds, there's a recognition of the brand and the regulatory framework around it. And so there's a relatively easy, but still a regulatory process, a registration process that Luxembourg funds need to go through. Some time ago, Australia and Hong Kong signed and executed a memorandum of understanding to allow almost the free passport of Australian funds into Hong Kong to sell to Hong Kong investors and vice versa. Not a single Hong Kong dollar has been invested into Australian funds. So notwithstanding a very technical regulatory framework or understanding between two Asian jurisdictions to allow the free movement of fund product, it hasn't been successful. But yet the Luxembourg funds that need to go through even a more onerous regulatory requirement are very successful in the Hong Kong and many of the other Asian jurisdictions. And that's down to brand awareness, it's down to the product itself, it's down to the flexibility of the product, the neutrality of the product. And I think that's a key issue. You know, Malaysian investors don't want to put their money in a Taiwanese fund. Japanese investors don't want to put their money into a Vietnamese fund. But everyone wants to put their money into a neutral fund of Luxembourg. It's brand neutral in the sense of it's not a nationalistic product. There's not a large market standing behind that product, and you know, I really think that's a major key issue for the success of Luxembourg.
Without wishing to labour this point, would it be fair to say that if I take that point, I think it's very well made, and exactly what Charles was saying as well is also well made. But would it be fair to say that if you are only looking to distribute your funds, say, in one market such as China, which is obviously such an existential size potentially, you would go with the local registered local everything fund. If you're looking for some regional footprint, then I understand. I take that point. You wouldn't. Yes. You wouldn't want the Taiwanese fund in Thailand and vice versa, etc. Yeah. Is that perhaps the way it might go? So for the international passporting, still the UCITS, but for those that are really building up local distribution, you do it. You go the next step and you really go and register everything locally and do all the servicing locally.
Well, that's the way it works in Europe as well. I mean, if you just want to sell in France, you create a French fund.
That's right.
But it also depends on the product too, and if you're and who the portfolio manager is and what kind of investing you want to offer. If you want to offer something local, then I don't see why you wouldn't do as you suggest. But if you want to offer, investment management covering all around the world, you've got obviously investment management expertise that isn't necessarily in every country. So, and for the moment, historic first mover status has gone to Luxembourg because those people have come to Luxembourg to set up their product. So I guess it also depends on the product you're looking to distribute.
It's very difficult for domestic funds from large jurisdictions to compete with Luxembourg product because they can't move as quickly as Luxembourg, because of the way in which Luxembourg is so unique in the sense of having this fantastic product with this fantastic support structure and depth of knowledge around, but with a tiny jurisdiction, meaning it has no real inward-looking view. It's all export-based. So every time there needs to be a change, a tweak, a new product launched, Luxembourg can respond within weeks or months to that. No other jurisdiction can actually do that. I'll give you an example. Recently, the UK has decided to try and catch up with Luxembourg to launch a new tax transparent vehicle. The government's been thinking about it for 6 or 9 months. The the Treasury's launched a consultation paper. The UK will toss this consultation paper around for 12 months. There'll be more discussions. It'll be years before this product is launched. If it was Luxembourg, that product would be launched, or that change to a product could be launched in a matter of weeks or months. How can large jurisdictions with large domestic populations, with an inward-looking focus, try and manage their own domestic product to compete with an export-based product of Luxembourg? It's very, very difficult, because every time they want to look at a change to their product, they're thinking, what impact will that change have on my big domestic market? What change will that be in terms of the revenue that I collect from that activity? I want to sell into country X, but I'm thinking about my particular market. Luxembourg doesn't think like that.
And I suspect the answer will be that the Gibraltars and the Maltas will probably get some traction in and around some of these alternative vehicles, some of these structured products and so forth, looking for flexible regimes, quick time to market and so forth. Talking of Malta myself, obviously I know it very well, they've got a great audit sort of consultancy presence. They have a fairly nascent financial sector, particularly around the funds business. And you know, I think their challenge is, if they're trying to tackle the UCITS brand, we've got 20 years of head start, and that's going to be difficult to replicate. Plus, of course, there is a language skill issue as well. You don't find your average Gibraltar or Maltese person with, some of our people have 6 languages, for example, fluent. That's not so obvious there as well. So I think they've got a role and they've got a niche, and I think they'll do very well in certain products. But it will take them time to really catch up, and it will take a huge influx, in my opinion, of talent from centres like our own, or from Ireland, or even the UK, and Asia potentially, to actually give them that institutional memory.
Okay. Anybody else want to answer that one before I move on to the next question?
Well, I think that those two jurisdictions are clearly looking to target Luxembourg. They're probably modelling themselves first and foremost on lower cost jurisdictions than Luxembourg. Come to Gibraltar, come to Malta. It doesn't cost as much to set up and operate a fund as it does in inexpensive Luxembourg. I don't think, I mean, that message may play out and be attractive to some, maybe some smaller funds that David mentioned, but I think, you know, in the long term, that's not really a viable message. They need to create a centre of excellence, and you know, Luxembourg has that, so, you know, the challenge is for them to do that.
But UCITS is the same for everybody, and AFMD is going to be the same for everybody, so there is no reason why other centres, just quoting some, but there are others, should not try and become prominent in that field. We certainly have a head start, but we have to be watchful and to keep innovating in order to keep our advantage, because competition is there, there's no doubt.
Yeah. Thank you. Right, another question from Sally. Talking further about Asia, what's the actual growth in use of Luxembourg funds in Asia? Do you have any figures? Does anybody hear any figures on the growth of Luxembourg funds in Asia?
Well, today, I mean, it's a bit hard to remember too far back, but as of today, something like, let's say, 10% of all authorizations held by Luxembourg funds are in Asia. About 5% is in Latin America. There's a little bit in the Middle East, but that's a lot on a private placement basis. Meaning is about 80% of the sort of distribution footprint remains in Europe. I think if you go back 10 years ago, in terms of that 10% of distribution into Asia, it was probably more like 2%. So if you look from a percentage terms, there's been a huge growth in the Asian segment of UCITS distribution, probably in the last 5 to 6 years. I mean, today, 42 of the top 50 cross-border groups have their UCITS product in Hong Kong. 48 of the top 50 in Singapore. If you go back to the year 2000, it was something like 15 and 18 of the top 50 were in those two Asian countries. So we've gone from, let's say 20 of the top 50 in Asia 10 years ago. Today, basically almost 50 of the top 50 are in Asia with their UCITS product. So in other words, almost none from the top 50 are not in, you know, at least 2 or 3 of the Asian locations. So that's a huge growth.
Yeah.
Without getting into figures specifically, because I don't have them, I have to say, as I mentioned, we've been in Asia for a number of years now. But when you look at the mix between Asia, the Americas, Europe, that has certainly moved into the Asian and America's favor.
Yeah.
Not hugely, but it has moved in that direction versus the assets sitting in Europe in the fund.
Unfortunately, there are no definite figures. I know that LIPA has a sales watch group where some of the groups are giving where their net sales are, and they have data available. And also, if you look at our website, we have a study from LIPA done for our 20th anniversary that gives some figures on the distribution net sales figures in the Asian region, but also in Latin America and in the Middle East. The proportion is certainly increasing in terms of net sales. Over the last year, there have been very flat years in Europe, while the Asian markets has continued to grow. So that's why the focus is also more and more on Asia, because we see net inflows into our funds from that region.
And just coming back to perhaps something you were saying, as you were saying it occurred to me, perhaps this is what I'm going to be supporting Luxembourg for is that if you're a Franklin Templeton or a BlackRock or a Fidelity, I guess, and it's a global brand you're trying to create, then I can see very much why you go and centralize things in the way that you've all been discussing here this morning. However, the reciprocal is if you are, and we haven't seen that I know of, and this is what just occurred to me, a local fund manager from China or from Thailand or wherever it may be, then you're probably not going to go down that particular, you're not going to avail yourselves of Luxembourg or Dublin or anywhere else. You're going to stay in that particular region.
No.
No.
So China Asset Management, one of the largest, if not the largest Chinese asset manager, has created a Luxembourg product.
Oh, really? Mm-hmm.
Why have they created a Luxembourg product? Well, you'd think to sell into Europe. Actually, some of their first target markets is back into Asia.
Right.
So isn't that incredible? We have Chinese asset managers. We have 2 Indian asset managers who created Luxembourg product.
Brazil as well, I think.
Yeah. So I mean,
Mirai Asset Management, which is the biggest, one of the biggest Koreans, they wanted to sell into Hong Kong, so they created Luxembourg funds to sell into Hong Kong.
I guess for that neutrality reason,
Absolutely.
in many ways that
And the brand.
Mark was speaking of. Yeah.
I stand corrected. I clearly stand corrected on that. Can I move to another question? This is, I think, is a very good question from Richard. Thank you for this question. How is Luxembourg positioned to meet the challenge of the continued downward pressure from fund distributors on fund administration fees?
That's probably me again as a fund administrator. But clearly there is downward price pressure, and there has been for a number of years. The total expense ratio focus has been enormous over the last few years. Investors demand more returns. Obviously in tough post-crisis markets, it's not so easy to get the returns you were before, so therefore there's pressure on the costs. The Luxembourg financial sector has for a long time been, particularly for the non-indigenous banks, heavily involved in offshoring and nearshoring, and that is still going at a pace. So the Polands of the world, or the Indias, or leveraging what we call low-cost operating centres, hate to use the word, but that's what they are in reality, is something that has been a feature for at least 5 or 6 years here, and has gathered massive momentum in the last 2 years, particularly as a result of post-crisis. So effectively what that's doing is it's lowering the cost of manufacturing, because you've got your engine room, if you want to call it that, in one of these low-cost operating centres where expertise is highly skilled, actually, to be honest. It may lack some institutional memory, but it's highly skilled. There are basic processes that are easily exportable, reconciliations, for example, price input, trade processing, and so forth. But the key is that what you do is you make sure that Luxembourg retains its intellectual command and control status. From a governance perspective and from a quality perspective. So it's almost a hub and spoke type arrangement. So a bit like the global regions, it's more about how you manufacture something cheaply in a controlled environment. And that will actually be the thing that drives down the cost. That's certainly what we're experiencing.
I totally agree with you. And in fact, I think the issue of the cost of doing fund business and the pressure on Luxembourg is clearly not a low-cost centre. Yeah? No. I actually think it has a number of advantages for Luxembourg, as David said, by being able to offshore part of that fund, machine and all the activities that support that fund. To be able to offshore part of that to a low-cost centre drives down the cost of the fund. But actually, what that also does, it frees up the time of the available resources in Luxembourg. So what happens is the talented, multilingual, diverse, experienced workforce in Luxembourg then starts to focus more on the more added value
Absolutely.
work around global fund distribution and less on the number crunching work. It's now focusing on product design and product development and those those very technical aspects around the distribution of the funds. So actually, I think it's quite an advantage for Luxembourg.
It's actually reinforcing our
to be moving
position
upstream on that. Yeah.
It's in terms of resource base, I mean, we're moving from what was the classic pyramid resource base with your foot soldiers and your layers of management and your senior management to the diamond shape. So effectively, you're going to have a few support staff, but essentially the backbone of your resource base is going to be engaged in this value-added intellectual command and control type of activities.
Yeah. In relation to that particular question, I'd like to ask you, I don't necessarily want to get into a big macroeconomic discussion, but I would like to raise the issue of the euro just for a second, because and indeed, of course, this applies to both Malta and to Dublin as well as to Luxembourg. But there are a lot of issues regarding the euro at the moment. There are people I know in Luxembourg who are in the heart of the EU right now, and no one would say there's any chance at all of a breakup of the euro. But there are a number of serious economists in different parts of the world that have serious questions about the long-term or even the medium-term viability of the euro. Your problem here in Luxembourg, and indeed throughout the European Union, if you're going to become a global base for the servicing of funds, is at the moment it's the fact that the euro is the cost of the euro vis-a-vis the US dollar, and Asia, of course, is very much a US dollar-based part of the world, and indeed Latin America would be in a similar situation. You have this, your costs here are in euros. The big two costs of an administrator are obviously salaries and rent. So that's all in euros. And despite the efficiencies and all the other stuff, there is a hardcore cost there that has to be passed on in some form or another. Wouldn't it make sense to take that out of Luxembourg, or indeed Ireland, or indeed Malta, and put that into the same currency zone as to where the distribution is being done?
Not necessarily.
I mean, why would you export part of the activity being done in a jurisdiction where the currency is being devalued to a jurisdiction where the currency is appreciating? Because then it's going to cost more relative to the local.
Okay, well, if that was potentially the case, and who knows what will happen if, I'm not saying there's going to be a euro breakup, I don't want to sound too dramatic, but in that event, who knows what would happen. But at the moment, it's gone the other way around the last 2 or 3 years. And I don't think it's so much a problem here in Luxembourg. We touched upon this last night, but I think it is a very serious problem in Ireland, where the vast majority of their business is Anglo-Saxon, and therefore their clients' currency is predominantly dollars or possibly pounds. Here in Luxembourg, the majority of your clients, you are other continental European-based.
We have 20% of Americans and 20% of Swiss and 20% of Germans. So it's much more diverse.
It's a smaller percentage that's not either Swiss, and Swiss franc is even stronger than the euro. It's either continental European, it's basically EU-based currencies, and Swiss, whereas I'm saying Malta and very much Luxembourg, it's almost all dollars and pounds. Sorry, yeah. Ireland.
Yes,
that's what I meant.
Yes.
Yeah, but hang on, Simon. You need to differentiate between the currency that the investor is using to go into the product, and Luxembourg funds are sold in euros and USD. If they're sold into Hong Kong, it's Hong Kong dollar. Absolutely. So if the investor's buying into their own currency, I'm not too sure.
No, I'm sure for the investor is the investor is not a problem. The problem is that's fine for the investor, of course, absolutely. I'm talking about the fund manager,
right?
Who's and looking at potential rising costs if the euro were to appreciate, or indeed opposite extreme, a disintegration of the euro and what that might mean.
I think you're forgetting that organisations do hedge their currency. So in my instance, for example, yes, you're absolutely right, my cost base is in euros, half of my revenue stream is in US dollars, half of it is in euros. The bank at the parent level actually hedges the half of the revenue and all of my euro costs back into US dollars. So effectively, it's always neutralising it out at the balance sheet level at the top of the house, effectively.
Yeah, but it sounds like your question's more sort of a macro question. Well, what if the euro disintegrated? What impact would that have on the distribution, on the operation of Luxembourg product generally, because it's based here? Is that?
Well, that was part of it. The other question was a more mundane question, which is what's happened over the last few years, which is the euro has appreciated very strongly against the US dollar, and therefore less a problem here in Luxembourg, but very much a problem in Ireland.
Yes, no, I agree.
Is that the service providers in Ireland are getting squeezed because of that. But it is also to a certain extent a problem in Luxembourg.
But on the other hand, in terms of the cost, the TER, I mean, is the administration fee the biggest piece of it? No, it's the distribution fee, it's the trailer fee.
Absolutely.
But it is one of the
I
costs.
agree, there's pressure. I mean, as a promoter, we're putting pressure on
poor people
well,
like
on
us.
ourselves. Sorry, we do it internally. We do our administration internally, but
you reduce your costs where you can, you know.
For sure, for sure.
That's the issue. Okay, and enough on the cataclysmic issues surrounding the euro, because we could discuss this all day long. The one thing we haven't touched on, we haven't got a huge amount of time left, and I do want to spend a few minutes on it, and although it has been referred to in terms of SIFs and QUIFs and whatever a little bit earlier on, is the alternative fund investing boom that's going on. And we have AIFM as a directive that's come in Europe very recently after a huge amount of discussion. It is potentially, and I emphasize the word potentially, creating a new class of alternative investments, which is a sort of hedge fund-like product, if we're referring just to the hedge fund industry. A question I have for you all is whether or not, if particularly AIFM does create this hedge fund-like product, and we have seen some redomiciliation of alternative funds from the Caribbean, most particularly Cayman, more to Ireland than to here in Luxembourg, but a bit to Luxembourg as well. Whether these are also products that would be sold in other parts of the world outside the European Union in the same way as we were referring to in the long-only UCITS funds, so out to Asia and to India and to the Gulf and so on and so forth. Is that something that you see happening, or is it indeed already happening? Anyone want to pick up on that?
Yes, I think it's still early days because the AIFMD is in its starting blocks, but certainly where I would not agree with you is that there would be more move to Ireland for the moment than there would be to Luxembourg. There is a significant move from non-regulated jurisdiction to regulated jurisdiction generally, and that has started already before the AIFMD because clients wanted that, investors wanted a regulated product. So with the AIFMD, it will, although there will be a passport for non-European products also in the AIFMD, I think that most asset managers will look at creating alternative funds in Europe. And there the choice will be the same as for UCITS, I believe. The choice will be very often between Ireland and Luxembourg. For the moment, if you look at non-UCITS regulated funds, Luxembourg is number 2 in Europe, behind, funnily, Germany. Germany has specialized investment funds, and in terms of asset management, Luxembourg comes second already for the moment in that space. That's for all non-UCITS regulated funds. It's an IFAMA statistic.
I think the other thing you have to remember is the dynamic around distribution is very different between some of these SIFs and structured products, and because it's largely private placement and institutional, as opposed to your retail global distribution.
Yes.
So you've got to bear that in mind.
Which is why the passport under AIFMD is a bit of a furphy, really, because when you talk to managers, they're not going to be able to, they won't really utilise or get much benefit out of having a passport for an alternative hedge fund. I mean, they're selling that fund in jurisdictions now, as David said, on a private placement basis to certain investor groups where they don't need really ostensibly a passport like there is for the use of product.
Although isn't one of the issues with the AIFMD the fact that the scope is so large? I mean, it's everything that's not UCITS. Yeah. So there are things in there like real estate funds that you might want to distribute on a more wide basis that are now caught by AIFMD. So maybe the passport could be useful for those.
I think that's the point. It's early days. I think people are looking at all angles, and obviously there are a number of regulators in certain markets that are, I call it anti-non-regulated or anti-non-UCITS, particularly in Asia, funny enough, right? It's been historically difficult to get a lot of product through Hong Kong. Good example. They're very cautious and conservative, which is probably a good thing in some instances. So the whole concept of sort of retail access to some of these products hasn't really taken hold yet. But I can see as an asset class, a lot of these things will eventually take hold, and potentially, absolutely, you could expand. But today, it's largely an institutional market, in my opinion.
The devil there is in the detail, and in order to get a political agreement, what happened is that on a lot of the touchy issues, the directive refers to level 2 measures, and the level 2 measures are being discussed at the moment, and it's there really where the decision will lie, what is going to happen. And that process is not over. So if I were an asset manager, I would still wait. I would not take a quick decision now. I would look at the details before I make any sort of decision.
What we have seen in research, International Fund Investment did in quite a lot of detail last year, is that the typical London-based hedge fund manager, who up until now had based his funds more often than not in Cayman, but somewhere in one of the offshore centres anyway, is opening funds inside, some of them anyway, already have done it, others are looking to do it inside the European Union.
Even as UCITS.
As UCITS, yes, absolutely. Not, in fact, more as UCITS than one of these QIFs or SIFs, actually. But they are not closing, they're not re-domiciling their business. This is additional to their offshore, we're calling it mirror funds. So they're not putting all their eggs in one basket. And indeed, in relation to Cayman in particular, but indeed the offshore centres as a whole, Cayman on the offshore side, Cayman in Asia is very, very popular.
Yes.
And especially Hong Kong and throughout the entire region, it's very, very, very popular. I would have to say I don't see necessarily why, if that's ABC hedge fund management in Mayfair, London, and he's got a Cayman fund and he's got a Luxembourg or a Dublin fund that's a UCITS, he's probably not going to be selling that UCITS fund very much in the Asia Pacific region. He's going to be selling his Cayman fund, I would guess.
It depends on what the client wants. Does the client want a regulated product or not? If he wants an unregulated product because it's cheaper, he's going to buy a Cayman Island fund, and if he wants a regulated product, he will buy the Luxembourg UCITS fund.
I think the impact of the global financial crisis, as Charles said, there were more investor groups and investor types, institutional investor types in Europe who decided we need to move to a more regulated product. So there was a significant amount of re-domiciliation from Cayman to Luxembourg or Ireland, creating not a UCITS fund, some did, but a non-UCITS product, a SIF or a QIF. But I think in Asia, the feedback that we've received from many, from the Asian region generally, is investors there have not been as concerned to move to a more regulated product. So, typically the board of trustees of a Dutch pension fund, they were sitting down through the global financial crisis, and all of a sudden, completely unregulated Cayman products didn't quite look as good as they did previously. Not only were the returns falling down, but there was an impact upon governance and control and regulation. They said, we're less likely to put as much money into a Cayman product throughout 2008, 2009, 2010 as what they had previously. And so there was a move to create more regulated product, not the UCITS fund, but the QIF or the SIF. The Asian investors less so. If you talk to Japanese institutionals, they were not concerned as Dutch and German pension funds were about having a more regulated product.
That's, I think, for the probably less sophisticated institutional investor, that's the case. The really largest institutions, again, research we've done shows it makes no difference. If you're an ABP with huge resources and putting a lot in, they're more than, and Hermes have said this same thing, they're more than happy to carry on allocating to the offshore fund. But if you're a slightly smaller pension fund with an allocation, you perhaps don't have that sort of level of resource.
Sure.
I think there is a certain element of truth in that.
And that probably means that the Cayman product will exist in the future. It won't collapse completely. It's not going to disappear because I think there will be a role for all these types of the super regulated UCITS, the less regulated but regulated QIF and SIF, and then the unregulated product. It'll be a menu of products for different types of investor groups.
Funnily enough, one of the places where alternative UCITS is having its most success is outside the European Union, in a place not that far from where we are here, which is Geneva, the Genevoise private banks, many of whom were badly hit by Madoff, and apparently their clients have told the banks they're only going to go back into hedge funds if they can get the liquidity and transparency that alternative UCITS product will guarantee, otherwise forget it. So apparently quite a lot of successful UCITS, or whatever you want to call them, in Switzerland.
Yeah, I mean about between 30 and 40% of all new Luxembourg UCITS products last year were what we would consider to be more sophisticated products. We don't like to call them UCITS. It's more of a sophisticated or alternative UCITS. Now that's quite a change, because if you look at the alternative UCITS product, in the whole UCITS universe, it's 1.5 or 2%. But yet in the last 18 months, 40% of all new funds have been in that sort of investment category. So clearly that's to meet the demand from investors in various jurisdictions like Switzerland.
Yeah. Well, we haven't got a huge amount of time left. I will say this last time to the audience. This is your last opportunity to email in any questions if you'd like to do that. For those of you who haven't been on one of our panels before, I'm going to surprise you now by asking you to come up with some predictions, because there will be an edited version of this particular webcast that will be up there. We'll leave up there for quite a long time in the future, and then we'll be able to see how accurately or inaccurately your forecasts are in, say, whatever it is at the end of this particular year. And I've been racking my brains over the last few minutes thinking of what it could be, and it's always good to try and get some specifics, but I can't think what that would be. So what I'm going to do is two things. One, ask for a general forecast. I know it's dependent upon hugely different things, where the Luxembourg funds market will end 2011 in terms of let's say UCITS and non-UCITS, part 1 and part 2 overall. You can all have a stab at that for fun. And secondly, in relation to the theme of this particular discussion this morning, if you could find some way, and I don't know what it is, in forecasting how Luxembourg funds will, if in some measurable way, will continue to develop outside the European Union, whether it be Latin America, the Gulf, Asia Pacific, or whatever it happens to be. Who should we go to first? Charles?
Well, thank you for the honor. What I think is going to happen is that the UCITS regime will continue to evolve, that the AFMD will be put into place over the next years and will create new opportunities, and that we are going to try to find new markets also for distribution of UCITS in countries where for the moment UCITS are not so easily distributed. So if you take the history of over the last 10 or even 20 years, we had on average growth rates of over 10%, so I'm quite confident, and I'm not taking too much of a risk if you say that if we stay in the average of what we had over the last per year, over the last 20 years, and the 10% growth, I think, depending obviously on catastrophes that might happen, but in normal circumstances, I would say an average 10% increase in that and other management is not out of real possibility.
Okay. And is there anything you can say in terms of Luxembourg-based funds development outside the European Union, particularly UCITS funds?
Yes, I believe that the popularity is going to increase, and we are working on that. We are doing roadshows constantly, and we are trying to open new markets. There are big markets still where UCITS products are for the moment not easily. Well, Australia marks home turf. China, I mean, is opening slowly with the qualified domestic institutional regime. India, Brazil. These are huge markets that are slowly opening up and where we have real possibilities.
I think Latin America for UCITS is where Asia was maybe 5 or 10 years ago. So I clearly many Luxembourg products into Chile and Peru because of the large pension funds. If you look at some of those other big countries, Brazil, you still can't sell a UCIT there sort of on a public basis, on a direct basis. But if you look at some of the changes in the regulations, especially with Brazilian pension funds, Argentinian pension funds, they are starting to allow a greater proportion of their assets to be invested into outside of Brazil and outside of Argentina. So I think over the next 5 years, I know you only said a year, I can see Latin America becoming sort of the new, at least a region equivalent to that of Asia. which I know is a big, a big step up, but I really believe that's a huge area. Charles mentioned Australia. Alfie has filed 2 class orders with the Australian regulator to get a much easier access to a large and mature market there. So I think that's quite important. If you look back in terms of the number of funds and the number of authorisations around the world, 2009 was basically flat. 2010, towards the back end, we saw a lift up both in the launch of new funds, around 3 or 4% in annual terms. I'm predicting for 2011 we'll see somewhere between a 5 and 10% increase in both the number of UCITS and sophisticated investment funds in Luxembourg, because I believe that what we're seeing both anecdotally and in the last 3 or 4 months is a large number of foreign asset managers coming to Luxembourg to create Luxembourg funds because they see demand for those products. So I'm quite optimistic for 2011.
Thank you. Well, will you be able to click on those very comments at the end of 2011 and see how accurately you've predicted them? Denise, can I come to you with any predictions, including other ones in addition to what I asked for that you might like to make, but anything in relation to what I asked for as well?
No, I mean, I think that we still have a ways to go in Latin America, but I would agree with the trend. I think one area that's going to be very interesting is China, but via Hong Kong and the renminbi business. I think that's going to be a very interesting opportunity. I'm not sure we'll be there by the end of the year because China is being quite cautious, which is understandable, into opening that business up. But I think that will be an exciting area of expansion within Asia. I think, I mean, I have written down 10% as well for the AUM in Luxembourg, but I suppose that's not surprising. I think the flows, I think we'll see probably a third of the flows continuing to come from Asia, Latin America. Although we'll still have strong flows from Europe. So maybe that's my additional flows from outside of the traditional European in terms of into UCITS products.
Okay, thank you.
For the year.
David, last word,
last
of the morning from you.
I'll keep them short and sweet. A couple of predictions. Certainly I agree with everything that's been said around Asia. There will be further penetration in Asia. Within the next 5 years, there are some people that are frightened about the Asian UCITS. To be honest, I can't see it in the next 5 years, perhaps in 10. Reason being that obviously they don't have the overarching regional framework like we do in terms of the United Europe in quotes. So they're still somewhat desperate in their, or disparate rather, in their own environments, bit too competitive. Latin America, I think you'll see evolution of potentially other channels. Today it's largely dominated by NSSC, it's probably the only route, effective route into Latin America. But I can see potentially alternatives or large distributors, particularly in the Brazils, opening up and actually allowing for more direct access. Global distribution support, I can see more and more the larger banks investing in providing value-added global distribution support as part of the suite of products which sets aside fund accounting and transfer agency and custody services. And that will obviously shift a little bit away from, dare I say it, the audit world, which is where that's largely housed today, because clients will expect their service providers to actually support them in that. Alternatives, absolutely. It's the fastest thing that we've got in terms of pipeline. We're seeing probably for every UCITS fund 3 or 4 alternative type products being launched by our client base, and a huge amount of interest. And in fact, the pipeline is probably something like, in our experience, 4 times stronger in Luxembourg for these type of products than it is in Ireland today, without fueling that debate.